Good morning, ladies and gentlemen. This is Aisha Abbas here with you again. We met many of you last week on Tuesday as well, and we thought that it would be an opportune time again, as we said last week, that we'll get together with yourselves once again on a webinar to have a conversation and to take your questions. So thank you very much once again for tuning in today and for taking the time to join us again as we continue our discussion of the evolving situation here in the Middle East, and particularly its implication for global markets and portfolio positioning specific to yourselves too. Over the last week, our relationship managers, our wealth solution specialists, and investment advisors have been keeping themselves very busy, reaching out to you, talking to you. So thank you for giving them the time, and thank you for reaching out to them as well to have conversations on a broad basis and equally specific to your personal portfolios so that you can be able to grow and preserve your wealth during these times, seeking opportunities and equally looking at what rebalancing acts that we should put into play to keep your portfolios on track. So since the last session, developments across parts of the region have continued to unfold. As always, our focus remains on the safety and well-being of our colleagues and our clients, alongside maintaining the stability of our operations. And I assure you that our team will continue to support you without any disruption, and we remain committed to being your trusted partner throughout, as we are here for good. At the bank, we're always by your side as you navigate periods of uncertainty and as you manage your wealth. With that in mind, as I said, we wanted to connect with you again today and provide you an updated perspective on the recent market developments. Of course, a lot happened over the weekend in terms of the market volatility. We saw certain markets opening in the red and then turning into green. We saw 2 days of consistent volatility, which is now somehow taking shape and markets are turning into green. So we thought it's a good time to get together and speak to Pratibha, who heads our managed investments and advisory, and to, of course, bring back Manpreet, who's a busy man these days, our Chief Investment Officer for Africa and Middle East, to get their perspective on how they see these market developments shaping our perspective, our views specific to what we shared with you earlier on in our house view as well. And ladies and gentlemen, I hope you find the discussion to be valuable. Please remain that our teams remain committed and they remain available to support you. So please do continue to reach out to your relationship managers, to your wealth solution specialists, to the investment advisors, and all of us here at Standard Chartered, because we are here to support you. With that, I will now pass it to Pratibha and Manpreet to give us their view. And of course, please do keep posting your questions. We have some questions that were left unanswered last time. We're going to bring those back in as well, plus some of the new questions that you're bringing through to ensure that we answer as much as we can. So with that, I will pause here and give it back to Manpreet and Pratibha. Thank you.
Thank you very much, Aisha. Good morning, everyone, and it's a pleasure to be speaking with you all again today. It's been quite a week in the global markets across all asset classes, and particularly in oil price movements. But that's a lot of noise as well that we've seen. What we wanted to do today was to bring that all together, share our perspectives, and help give a perspective in terms of what it means for everyone's portfolios. So joining me today, as Aisha mentioned, is Manpreet. Manpreet, thank you very much. I will start off without further ado. Very quickly, I know we spoke about this last week as well when we connected with our clients, but I just wanted to touch base again in terms of, what our scenario analysis is of the current market situation or of the, situation in the Middle East and how that's been unfolding. Because I do understand when making investment decisions, I think it's thinking in terms of scenarios is possibly the best way to kind of break that down to help understand. So what is it that you are looking as likely scenarios? And also, how do you think it's playing out so far?
Thanks, Pratibha, and good morning, good afternoon, everybody. You're right. I think the best way to deal with these sort of situations where the outcome is far from clear is to think in terms of scenarios. That's been one of the more successful approaches, both for investments and larger decisions in these, very fluid situations, because it allows you to, put a framework around which way the events could play out. Make sure the focus is naturally on the one or two variables that matter, because we're in an environment with a lot of noise, and to make adjustments as the situation evolves, and you can see events proceeding towards one scenario or the other. So that's still, we think, a really useful tool. Put a framework around trying to figure out what's going on and what it means for markets. Now, we've obviously, if you obviously have read any of our materials or you were at the previous call, you know that we've centered our scenario around oil prices, because from a financial market investor, that, in our view, is still the main channel back to markets and how we might think about different types of impacts. And our views here have not really changed, right? So if you recall, there were three scenarios. The baseline scenario for us is still a disruption to energy supplies that lasts a few weeks as opposed to a few months, right? So that relatively short-lived disruption, of course, does involve oil prices that briefly rise, and we seem to be very much in the midst of that. But ultimately, what's important here is how long oil prices stay at high levels, right? Because if it's a very short period, then the average price for the quarter of the year is not significantly altered. But if it stays there, obviously, for a couple of months, then your impact can be much, much more real. So basically, we think it will be relatively short-lived. And that's obviously an environment in which we should expect a bit of short-term volatility. Expect some hedges. It will make sense to put some hedges in place, but equally look for opportunities and not alter long-term portfolios. There is the upside scenario where we end up in negotiations quite quickly, and perhaps Trump's most recent comments reminded us how quickly things can change on that front. But equally, there is the downside scenario, right? That the conflict ends up disrupting energy supplies for much longer than a few weeks. So those are our scenarios. And what I would say is that so far, we seem to be proceeding down that baseline scenario. Obviously, that's very hard to say from a conflict perspective, but at least when you look at the market reaction worldwide outside of this region, with the exception of perhaps the oil price itself and a handful of the high beta Asian equity markets, most of the major asset classes appear to be reflecting short-lived rise in oil prices, but perhaps not one that is super prolonged. And I think that's what gives us confidence with the highest probability on that baseline scenario sitting here today.
Thanks, Manpreet. I think it's a great way to kind of set the tone in terms of what our expectations are. Just if I were to turn around now to the asset classes and the way they've moved over the last 1 week, now that we've kind of spent that 1 week in the midst of conflict. Clearly, what has come across is there has been big moves in oil, and as you rightly pointed out, our baseline is also around oil itself. But energy markets, understandably being in focus, how should investors interpret the recent moves in oil prices, right? Of course, I understand it's very news driven, so to speak. But is this a temporary geopolitical premium or something more structural, you think?
I think what oil prices and to some degree gas prices are reflecting, right, is the fact that de facto, it appears a decent amount of supply has been taken off the global table, more because it's difficult to ship out supply. And I think it's interesting that most of you know this through the media, but perhaps to state the obvious, it's the ability to ship out supply, whether it's crude or refined product, through the Straits of Hormuz. That, of course, is the key bottleneck. And what we hear in reports, of course, is major producers, starting with Iraq, of course, starting to switch off production, not that because they can't produce, but because their storage is now full and they need to ship the produce out. And I think when you think about the reaction in oil prices, that's really what it reflects, of that temporary disruption. But I think what's interesting with oil, right? I think there's obviously a huge temptation to focus on headline oil price. That's what the screaming headline will tell you. What we've been looking at, of course, is the oil price, future expectations. There's a whole future curve this for the next 12 months. And it's interesting that market price for oil are very high for immediate delivery, right, over the next 1 month, 2 months. But actually, if you look at the future curve going out through June and beyond, it actually is pricing in a return back to that, status, pre-conflict status quo, right, back to your $60 type range. So I think that's effectively what the oil market is telling us. We know the disruptions are real. Restarting, we know, is not easy when you speak to specialists in the industry. But look, in practical terms, again, we're discussing weeks rather than quarters. So I think it all sort of rolls up to oil markets. We see that headline oil price, but it's pricing in our view, that baseline scenario, the disruption is front loaded. Of course, we don't know how many weeks exactly, but it comes to the point about weeks rather than months. That's what the oil market, when you look at the curve of the next 12 months, really seems to be telling us.
Okay, thank you. I'm just going to touch upon the weekly market publication that our CIO team has released. We've also released a market watch yesterday, talking about the overall disruption in the oil space. And I'd like to call out one of the key themes in the report, that higher oil prices could push up inflation expectations, right? So, how concerned should investors be that this might delay central bank easing? And at what level do you think does oil start to change the inflation outlook materially for us?
No, that's a really good question, because we should make it clear why we're so worried about oil prices. The feedback loop we're focused on is, okay, higher oil prices. One place one would expect to see the impact on the global economy and markets, when it becomes more of a concern, if it becomes more of a concern, is on US inflation, right? Because higher oil prices mean higher gas pump prices, higher jet fuel prices. So markets tend to start pricing in those sort of worries in inflation expectation markets. Now, we've seen a little bit of an uptick, but again, it's an uptick rather than a rise. And it's again more in very short-term inflation expectations rather than long-term inflation expectations. So similar picture about correlation working as we expect, but pricing in a short-lived disruption as opposed to something more long-term or sustained. But you're right. I think when you start thinking of the more worrying scenarios, that this disruption lasts for longer than we expect, inflation is the first place we should expect to see it. And inflation obviously follows on the question that inflation becomes more of a concern. It does make it harder for central banks to cut interest rates, regardless of what the growth side of the job market might look like. Now, sitting here today, I think it's premature to be suddenly reassessing, central bank or Fed rate cut expectations, because we do need a few weeks to really verify whether this is playing out along a base case scenario or not. If this is a base case scenario, and in a matter of a few weeks we were able to go back to oil prices that are significantly lower than where they are today, then we go back to the pre-conflict scenario where the Fed will say, okay, we had a bit of a worry, but we're back to a world where inflation is not the main problem. It's the fact that the job market is so soft. That's what the last US job market data told us. And then we go back to a world where we still think 2 to 3 rate cuts make sense. But remember, we're not so focused on how, the specific rate cuts themselves, whether we get 2 or we get 3. We care about them because that's what helps support growth, and hence supports our weight on equities. But I think for inflation to become a bigger problem, we need oil prices to stay at high levels, start to gradually push up the average, and we should expect to see those worries first play out in a downside scenario in inflation expectations. I think that's the only scenario where we'd have to reconsider some of those Fed rate cut view. But at this point, it just feels a bit premature to go down that path.
Okay, great. Thank you so much, Manpreet. That really gives us a, understanding of what we are thinking about Fed rate cuts, because clearly markets are already pricing in fewer than 2 Fed rate cuts already, right? Maybe a good time to bring in a question around the bond markets, right? Are you seeing any impact in the bond markets now that a week has passed by, and particularly around GCC credits? I know we touched upon it last week as well, but now that we've run through this over a week, I ask also particularly because we have clients holding long duration GCC sovereigns. Given the elevated oil prices, inflation expectations, uncertainty around Fed rate cuts, etc., how should they be thinking about their exposure now? Is this a moment to reassess duration risk in fixed income portfolios?
In a word, yes, right? And I think I'll focus on, maybe there are 3 sort of moving parts here, and I'll talk about each one. But I think I'd be less worried about the credit quality. I think that's where a lot of questions were. And at the end of the day, the higher quality DCC sovereigns or sovereign linked are still extremely high quality. So I wouldn't worry about that. But duration is ultimately a US rate score, right? These are dollar denominated bonds, nothing to do with the credit. So I think the key here is, look, number one is, look, the dollar denominated bonds. So everything we discussed about US interest rates, we have seen a little creep higher in US bond yields across the board. But to me, that's part of the correlates move higher in the dollar. uptick in inflation expectations. But if you think about it, 10-year US bonds are still within our 4 to 4.25 range. We moved to the higher end of that range early in the week. We're back to about the middle of the range today. So fits with our base scenario, right? So to get yields a lot higher, we need to go down our worst case scenario. We're not seeing that today. The second thing, of course, is the credit risk, right? Which is what you're layering on top of US government bond yield risk when you buy a GCC sovereign. And look, I don't think a view has changed from the last time we had this conversation. One should expect spreads to widen a little bit, just as part of a broader global, risk off. But one would not expect that to be significant because if you think about some of the higher quality, larger sovereigns, KSA, UAE, those kind, look, credit quality is still very high. Seen many rating agencies, of course, reinforce that. But in our view, these are very, very high quality credits. And to my mind, that is also why wherever we've seen spreads move, it has been quite a relatively muted move, right, outside of the initial day one uncertainty. The third point, of course, to your point is the key one, right, the duration. Because when you think through the different scenarios, in a positive scenario, this all goes back to the way the world was before this conflict started. And we're correct about slower, falling interest rates in the US. Then yes, okay, that's a scenario where most bond durations will do well. But the challenge with long duration bonds is that if we get even a partial market worry about higher inflation, is that a risk or markets are priced to some degree, the impact would be disproportionate the longer your maturity profile. So you take more of that mark-to-market risk as 30 years than you do 2 years or 5 years. So in dollar bonds generally, whether it's VC credits or anywhere else, we've always held the view, we held this view for quite some time now, that we think 5 to 7 year maturities are the sweet spot. Because yes, there is a trade-off between going further out and earning that high yield, but also trying to limit your mark-to-market volatility when you have worries about inflation, right? Where being further out is actually a negative. So in our mind, this is just a good opportunity to consider where it makes sense. Obviously, each portfolio is different. That's a conversation you can only have with an investment advisor in your own situation. But at a broad level, we just think that 5 to 7 year maturity, that's a much more attractive sweet spot in terms of the risk-reward trade-off, as opposed to long duration, because in the downside scenario, that just carries the most potential pain. Not because there's anything wrong with the credit. Credit quality will be fine in that scenario, but you'd expect long US bond yields to actually rise by a lot in a more inflationary scenario.
No, thank you so much, Manpreet. That adds a lot of context, right? I just wanted to touch upon another point around the same space and follow through. So yeah, point noted, should exit long duration bonds. It's not so much the credit, but the duration in question. But in terms of the bond market liquidity, do you see concerns rising there? If not already, but an expectation that, when investors actually reach out to kind of sell, you may not really find too many buyers, given, it's a widespread situation, everyone's aware of it. What's your take on that?
I think this is where we can learn a lot from past market stress situations, right? No doubt in the short term, if you talk to people who are trading this day to day, there is some conversation about liquidity being, a challenge, especially earlier in the week. But I think that's a market pattern we've seen consistently across every type of, market sell-off or stress event or, negative headline, where in the very short term, and you're usually talking just a day or two, right? Is when you tend to see liquidity drive when everyone's trying to assess the situation and say, okay, where could this go from here? But generally speaking, unless you're going down some of the worst case scenarios, liquidity is the kind of thing that usually tends to come back. And this is something we've seen time and time again, right? I mean, before I moved to Dubai, in Singapore, we saw this across almost 15 years of Asia dollar bond markets. When you have market stress events, Asia dollar bond sell-offs, broader risk asset sell-offs, worries about specific credits, it's perfectly normal to see liquidity get a little difficult for a day or 2 or 3. But that by itself is not necessarily a negative signal, right? Eventually, all markets function, and there's a price for every sort of situation. And I don't see this being any different. One good gauge to get a sense of how worried markets are is not so much the spot bond market, because there, without trading, the credit spread, what does it mean? Is it real? It's fair to ask. But you tend to see, I don't know how many of you might be familiar with, the CDS market. It's just the pricing in default probability. And that tends to be a more liquid market. You see, at least when people like myself watch markets, you tend to see a reaction that's a little bit more live. And I think it's interesting that in that market, it's the same story we started out, right? You see a market that's pricing in a little bit of spread widening, but you're not seeing a market that's pricing in stress or a big material change in the credit outlook. So I think it comes back to where we started, right? We should expect, even if there's liquidity in a bond here and there, we should expect that to normalize as markets sort of get more comfort with what scenario going on. I don't think we should worry necessarily about the credit quality, but we should expect a moderate amount of spread widening. If you're holding the bond or bonds, that's not necessarily a worry. But I think what's interesting is that if you've been looking to add and just found the whole market expensive over what has been for a long period of time, these are also the kind of markets where you tend to get the best opportunities.
Thank you, Manpreet. That's very, very clear. Thank you. Maybe just I'll take a pause and let our viewers know that this is a great time to start adding your questions if you have any directly to Manpreet. We'll pick that up as we go along. There is a Q&A option in the Zoom screen that you may see. Just type it in and we'll pick it up as we go along, and I cover off a few of the other major questions. Thank you. Okay, so maybe, okay, we've spoken about the bond markets. Now just let's touch a little bit about currencies, right? Actually, let me start with the USD basically has broken above its 200-day moving average, right? And you see longer term downside risk for the dollar. Can you explain that view to clients who are actually seeing the dollar strengthening right now and wondering whether to act on it or not?
So I think what we're seeing with the US dollar at the moment is, that safe haven move. Because in every context, it's worthwhile asking, we know what the universe of the usual safe havens are. But in each context, it makes sense to sort of step back and say which safe havens are functioning more like safe havens and which ones less so. And I think in the current environment, it makes sense that the dollar is acting as the safe haven because the US is largely self-sufficient in terms of oil output. So arguably, relatively speaking, the least sensitive to the environment we're facing. While, let's say, something like the Japanese yen, which otherwise does act as a safe haven, but Japan is a major oil importer, right? So without supply of oil, arguably more challenges there. So one would expect the yen to function perhaps a little bit less well. So I think that explains why we have seen some dollar strength come in since this conflict started. But I acknowledge the point about, okay, we're sort of creeping above the 200-day moving average. And look, I get the significance of that technical signal, but equally it's far from a perfect signal by itself. Right? I think the way I would look at it is it sort of fits into the broader spectrum of markets. A dollar move so far has still been quite moderate and is sort of quite consistent with the rise in bond yields, the uptick in inflation expectations, but all of which lines up with a base scenario rather than a worst case scenario. If I had to watch a technical level, what would be more important for me is when we break back into the 100 to 110 range on the dollar index, the DXY, or if we stay below that. And so far, the dollar stayed below that. So I think in currency markets, to my mind, it comes back to scenarios. If we are truly in a base case scenario, then yes, the dollar can stay well supported around these levels for a period of time. But again, if we're talking weeks rather than months, we can quickly go back to a world where Fed is able to cut interest rates again. And that's been one of our main rationale for expecting a weaker dollar, right? And a base case, we'd expect to go back, only a question of at what point and how long we have to wait in a sideways dollar bond market. I think for the dollar to go sharply back higher from here, we need the market to worry much more about that downside scenario. And look, it's not impossible. In our last note, we said, look, we see a 70% probability of that base scenario, but 30% scenario that 30% probably we do go that downside scenario. So it's not a risk we can ignore. We need to keep on top of it. But sitting here today, this feels like the 70% scenario is what we're experiencing and what we plan for at a baseline level. Maybe it's a good hedge if someone wants to hedge against going down to 30%. The dollar is as good a place as any. It's been learning from the last few days. But I think that's the rationale behind our thinking.
Got it. Thank you very much, Manpreet. Sorry, Aisha, I think you had a question. Maybe if I could just pass it to you now. Thank you.
Yes, okay, thank you. Thank you very much. I'm going to, Manpreet, take you back as Pratibha is moving through the asset classes. But I know you spoke about oil. There was a question that had come up on oil, that do you believe the flows will weigh on energy-dependent economies? I know you did cover it, but if you could elaborate a little bit more, specifically concerns rotation from the US into Europe and Asia. and if that's going to have an impact. And I think the market saw a little bit of that earlier on as well. And once you answer that, then there's something, obviously a lot coming on again on the fixed income side. So bringing Pratibha back onto the fixed income stream. But if you could take the oil question, and then I'll come back to you in a second. Thanks.
Sure. No, of course. I think when you think of the market reaction, right, the focus immediately shifts to Asia in particular, because when you look around the world and say, okay, who's most dependent on continued flow of physical crude and refined product, most Asian economies are quite dependent on imports. Now, to some degree, that is balanced by countries having varying scales of reserves that can obviously help buffer short-term disruptions. But to my mind, that is why we saw the biggest sell-offs in the most North Asian markets. So Japanese equities, Korean equities, Taiwan equities. And I think these markets have two things in common. One is, like almost all of Asia, the high degree of dependence on the flow of energy imports. And second is they're also coming off a point where these markets had performed extremely strong, which means that investor position was quite long. There were a lot of investors to actually sell. And we saw that perhaps most visibly so in Korean equities. And to my mind, that second factor is the key difference with, let's say, Indian equities, which is the other place investors look to as a highly energy import dependent market. But to my mind, the scale of the sell-off has been relatively more muted, simply because that's a market that has already underperformed. So we're not coming from a difficult positioning starting point. So I think that concern is valid. And it comes back to a scenario. So in a scenario where this is truly short-lived and physical flows start to kick off in a few weeks, then this could potentially be a great buying opportunity. And look, we're overweight Indian equities, partly because we believe the markets have been excessively beaten up from a relative perspective and increasingly from an absolute perspective. And on most valuation measures I've seen, the rupee looks quite inexpensive. But of course, in a downside scenario where this is more prolonged, one can imagine these are the economies which will face more growth challenges because of that restricted energy import, unless, of course, different sources of energy are available to cover that gap. For a market investor, though, I think that's where, when you think as an equity perspective, in a scenario of elevated oil prices, I think there's room for the US to at least temporarily outperform, simply because of lowest energy dependence. I guess Asia is perhaps the most potentially impacted. But I think the bond markets, it's a little bit different, because if I look at, we're also overweight emerging market bonds. But emerging market bonds, the benchmark, is a little bit different to the equities benchmark. Emerging market equities, almost 80%, 70 to 80% of that comprise Asian equities, while in bonds, you have a much better balance between Latin America, emerging Europe, Africa, and Asia. So almost a 50-50 mix of importers and exporters. So on the bond side, arguably you're a little bit better protected compared to emerging market equities, where there's a bigger exposure to importers.
Right. Okay. So on the bond piece then, as well, Manpreet, you've answered that, because there's a question around, what's our take on bonds? Are you still bullish on bonds? And I think you've covered whether it's EMDM and where positions can be taken. But one other question that is coming up is, we recently had a global market outlook. You spoke about a portfolio construct and you showed a pie chart. Are you still holding to that? And what is your view on alternatives within that, specifically gold? And in the short run, what do you see happening to gold? So it's a two-pronged question. Thank you.
No, great point. I think the pie chart I put up was our model portfolio allocation. After accounting for all our views, all the overweight, underweight jargon that we all, people like myself, love to use. I think the pie chart, which is what we publish in our global market outlook each month, and we do publish it for every risk profile and income allocations, those are still valid. No changes there. And I think it fits with the point we've been making since the start of this conflict, that we do believe we're in a world, and our base case scenario is consistent with that where we'd be happy to put on hedges in addition against short-term, obviously, oil price rises and all the volatility that comes with it. But we would not be changing that long-term foundation portfolio, right, which is what the pie chart reflects. And so that sitting here today, given the way we're seeing scenarios, of course, we have to react if scenarios change. But sitting here today, based on base scenario, we wouldn't be changing those foundation allocations, the pie chart. Now, gold sort of fits in the second part of the question to say, okay, what are those hedges, right? In the short term, the hedges we've been focusing on, I'd say twofold. One is direct and or asset classes that are directly correlated to oil prices, because that's where the risk is emanating from. So U.S. energy sector equities, U.S. inflation protected bonds. rebounds, right? Those are two ideas which have been directly correlated, and we've seen them perform to some degree already. The second category, though, is where gold fits in, right? Because we are overweight gold, we continue to be overweight gold. And gold as a risk hedge, it's one of the obvious places to look alongside the dollar, it's with the universal traditional risk hedges. The reason we like gold, though, and we're overweight in that pie chart long-term foundation portfolio, is that we like it for many more reasons than a risk hedge in this world, right? We like it because central banks are still buying gold. We don't think that that has really gone away. In the short term, right, a higher, stronger US dollar, higher interest rates, they do lean against gold to some degree. And I think that partly explains why we've seen gold largely sideways in the last few days. But to my mind, if the goal is to have longer term hedges, gold is still an asset, like partly because we like it for so many different reasons. Alternatives more broadly, in our mind, that core allocation, that long-term allocation, and foundation plus allocations, that to our mind still makes sense, right? Because, and we saw this in 2022 to some degree, when we saw stress in a lot of the liquid public markets. Actually, there was a combination of commodities and alternatives which really helped portfolios stabilize and outperform, let's say, a 60-40, for example, by quite a large margin. So yes, I acknowledge particularly there are individual parts of private markets which have their own separate challenges and headlines. And our view there, when it comes to private credit particularly, is that we do expect noise, but as long as manager selection is high quality, that's a noise that we're happy to look through. But I think at a portfolio level, that diversity provided by private assets and gold, times like this, that's actually quite valuable.
Thanks, Manpreet. Given that, this session is for our, more sophisticated private clients, and hence, there's always that interest in alternatives, and everybody asks about gold every time. So thanks for that perspective. But equally, there's quite a simplistic question that has come through, which is great, and that is what we expect from those who are on this call to please ask any question, whether complex or simple. And it just simply talks about, Manpreet, your view on, and Pratibha, please feel free to add on in your capacity as head of advisory. Are there any basic do's and don'ts during the volatile period? And if you could go beyond diversification, what is it specific? I know we can't be specifics as such, but that could be avoided, or any opportunities that must not be missed. And beyond diversification, if you could talk about the do's and don'ts, please. So please, Manpreet, if you could start, and Pratibha, if you could add on from an advisory lens. Thanks.
Sure. So maybe I'll start with a couple of do's and don'ts, and how we're translating those into how we're treating opportunities or risks, right? So yes, going beyond diversification, that's the obvious one. But I'll still say it, make sure you're diversified, right? We don't like concentrated positions, and these are exactly the kind of markets when you learn why. But the second thing I'd say that the key here is to not react emotionally. I think especially for based in this region, that we know when markets are volatile or there are headlines, there's a temptation to react more emotionally. But actually, it's a great time, a much more successful strategy is order to step back and take a more rational view. And that we recognize it's hard to do individually, but that's exactly why investment advisors are available to sort of walk you through that. And that's a process we follow at our own investment committee, right? We make sure we already have a few people in the room who can help disagree with you and provide a range of perspectives. And the third thing is it sort of treats the point on opportunities, right? You don't need me to tell you what the risks. There are enough things to worry about at any point in time. But equally, let's not forget that not being invested and missing some of the biggest rebounds in markets, which tend to come around stress events, can really hurt your long-term returns. And second is that these are also the kind of markets when you tend to get the best buying opportunities for long-term investors. So it's important to put on that hat on both sides to say, okay, where do I need to worry and protect my portfolio? But equally, and we've seen many clients come to us with this sort of question saying, okay, this gets a little bit worse. Where should I be looking for opportunities? Where can I buy relatively inexpensive assets that could provide an opportunity? And if you want more details on that, on how one might approach that, our Market Watch presentation, put that out, I think, about the second half of this last week, has a few tools that can help you overcome some of the human psychological biases. So we talk about, obviously, there's buying, rule-based buying, but also your thermostat approach, shopping cart approach. These can all help you make sure that you add a bit of discipline when it's not the easiest time to press that buy decision. And last point I'll make my hand over to Pratibha, right, is just a couple of areas where obviously focusing on the opportunity side. So one is, look, GCC credits, right? And we've spoken enough about the risks, but also effectively they're high quality credits. So if you're able to buy them at wider credits, wider spreads, that's something we'd obviously be happy to do. In a foundation portfolio, one discussion we are having, it's of course on Asian equities, because outside of the worst case scenario, some of them have sold off by a lot. So if it's not something that's likely to be long lasting, then it's worth examining whether some opportunities have been thrown up in the most recent sell off. So those are two examples of opportunities we're looking at. And third, maybe what we were looking at even beyond before all this kicked off was the relative underperformance of US equities and US tech sector in particular. I think that's obviously one still worth focusing on. So you can see when you apply some of what I spoke on the first part, and you look out at markets with that perspective, automatically you can see, leaving aside that worst case scenario, there are a few opportunities to start to emerge.
Thanks, Manpreet. And I think, I mean, while you've covered all of it, right? Just to keep it very, very simple, and we've seen this in conversations that we've had with clients over the last week already. While I think a lot of our investors are very aware of, volatility in the market, disruptions. I mean, we've had COVID, we've had the GFC, etc., right? One of the key things is to keep emotions at bay. If you look back in time, I think in almost all disruptions, if you can ride out the volatility, you'll see that the pullbacks in a bear market tend to be short-lived, and markets have continued to rise on the back of um, centuries of growth and technological progress, right? I mean, we've always seen it. Yes, it depends on the severity of the situation, that it may take a very, very short period for it to bounce back, as opposed to slightly maybe longer period. So it's more a question of how long can you just stand and hold on to your portfolio. Don't look at it and wait it out is what I would say. But more importantly, I think while doing so, it's best to assess what risks you've taken in the portfolio, just to ensure that you kind of reduce your risks if there are any specifically higher exposures to some either borrowing risks or currency risks, etc. So assess those, or the long duration ones that we just spoke about in terms of bonds. Assess those risks and take the calls on those. But other than that, I think as long as you're sticking to your investment plan, keeping the today, tomorrow, forever in mind, I think it's absolutely okay to ride out the volatility, because in most probabilities, these kind of volatilities are short-lived, and also markets kind of tend to bounce back over a period of time. We have, as Manpreet mentioned, launched a market watch detailing around the guide on a guide on how to manage volatile markets. If you have a chance, please do take a look at it. We've sent out a video of the same of our CIO speaking about this, as well as there is a document detailing all of the steps. If you haven't received it, please reach out to your relationship manager or an advisor who can actually share this with you, because that actually puts down in steps in terms of what you could do in such market conditions. Thank you.
Okay, and Pratibha, if there's a theme that is coming through, specifically around immediate portfolio decisions, especially for clients who are invested in more very long dated bonds. I think we talked about that, but there's still queries coming around that, and specifically for those who have leveraged positions, should they be doing anything differently in that space?
Oh, it's a great question, Naisha. I think it's all about what we're doing in terms of execution now with the portfolios. Like I mentioned, I think assessing the extent of the risk is important that you've taken in a portfolio. That is to begin with the leverage extent that one has in the portfolio. The second one is in terms of any cross-currency lending that has been possibly taken. But again, to Manpreet's point earlier, we've seen that USD has been strengthening. So if there has been any cross-currency exposure, then I think it may have been muted. But it's good to kind of have those checks done in a portfolio. And then if you go back to our narrative, we've even now we stand with a pro-risk view. So in fact, I mean, it segues very nicely into a couple of questions that I had for Manpreet, which is also covered off in our market weekly view. we are actually saying that increase, exposures to some equities where we think, we see a lot of value today, even with all that is transpiring. And maybe we'll touch upon that shortly.
Okay, that's useful. And Manpreet, do you want to come in? Sorry, were you going to come in?
No, I was just on the last point on Pratibha was making. I was just going to
Please
say
go ahead.
that, yeah, absolutely on the high quality equities, right? I think this is a market where obviously quality matters disproportionately. But just as an example, right, of the opportunities, one of the themes we've been discussing before the conflict was in the US rotating away from just technology and concentration in technology alone to being a bit more balanced across other sectors like healthcare, utilities, and that's a great example of and potential opportunity to rebalance to actually align with where we see the longer term opportunities and fitting that point Pratibha made on quality. I think that applies equally on the stock side as it does on the bond side.
Thanks, Manpreet. And Pratibha, as you come in with your next question, Manpreet, we know you spoke about Middle East credit, but specific to GCC credit, long-dated bonds, is there a view? Obviously, we're seeing some volatility at this time, but is there a view on that in terms of for clients holding positions in long-dated bonds and on Middle East credit, specifically to the GCC as well?
Sure. No, I think the key one here is it's two pieces, right? I think number one, from a credit quality perspective, no. And and I think that comes from a bigger picture of public finances, right? Because yes, you could argue there's the immediate pressure of, okay, there's less energy flowing, and obviously for economies like the UAE, which also have exposure to a lot of non-energy sectors like travel, tourism, shipping, one would expect some short-term impact. And how much also comes back to the point about how long this disruption lasts, because if this is all just a few weeks, then on full year statistics, you may not see as big an impact. And for more energy-dependent economies, ironically, higher oil prices actually, leans against the downside because for the amount of volume, of course, is an issue, but higher oil prices are actually positive rather than negative for public finances. And if you think more broadly, why we're seeing rating agencies come in and say, look, we're not concerned about the credit quality is because one is the immediate sort of fiscal balances. But when you start adding some of the long-term reserves and sustainability, these are obviously some of the strongest credits out there. So I wouldn't worry too much about that. I think the point on duration is the second piece, which is a bit more individual. Because obviously when we say, and that's why I say look, we have our view, and I explain why we like 5 to 7 years as the key one. But this is where obviously you still need to have that individual conversation with your investment advisor, because obviously in a scenario where your goal is to be long term and hold it for 30 years and mark to market volatility is not of concern, then I wouldn't be concerned, right? Because yes, mark to market volatility will happen when you own sort of a long maturity, high duration, interest rate sensitive assets. The question is really to degree to what that matters to you. And we know it matters to many investors, which is why we advocate 5 to 7 at a general level. But of course, if for other investors where the goal is credit quality for 30 years and the yield that comes off it and mark to market is not important, that's of course a separate conversation. And credit quality, to my mind, is not really the key concern, at least the high quality GCC, sovereigns at this point in time. But that's the conversation and the value an advisor can add. Pratibha, I don't know if you want to add on that point.
No, I think you've covered a lot of it already, Manpreet. All I would like to add is that please do reach out to your advisors and RMs. They're also fully aware of all of this because we have had conversations internally within the organization around this. So they're very prepared to kind of walk you through what are the possible scenarios on a case to case basis, right? Because this is very difficult to generalize, but on a case to case basis we could look at the individual credits that you may hold, the duration that you have, exposure you have, and then possibly provide solutions as to whether or not to kind of exit and rebalance. So that's possibly all that I'd like to add at this point on this question. But I want to Aisha, if I can just take over, I do have a couple of questions on the equity space. And one of them, I want to draw your attention, Manpreet, on the US aerospace and defense equities that we covered off in our outlook. that's obviously a key beneficiary of this environment. And with projected EPS growth rates of over 14% in 26 and nearly 20% in 2027 already, is it too late to add, or is there still meaningful upside in that sector?
No, I wouldn't say it's too late to add. In fact, we've added the idea not too long ago. And look, aerospace and defense as a sector has obviously done well for several quarters now, as we've seen the world arguably change in ways that impact that sector particularly. But in our view, it comes to that earnings number that you described, right? So just like any equity sector, if you sort of strip away, the headline impact and sort of just judging it on past performance alone, I think the key is that look from this point onwards, if those earnings growth numbers are indeed anything to go by, then we know it's not just about what's priced in already, but quite a bit of expectation of that earnings growth sustaining in the future. So in our mind, it's not too late, and I think it's a great example of a sector where the opportunity is not just about see what's happening at the moment in this individual conflict, but I think it goes a little bit beyond that. Particularly since we have seen quite a bit of military action, and frankly, if you look at just the amount of defense spending around the world, starting in regions like Europe or even beyond that, that's where I think those earning expectations are what really make the sector exciting.
Thank you. Sticking on to equities, right? I know that we remain positive on both China and India over the next 6 to 12 months. Although year-to-date performance hasn't necessarily been as expected. But for China, I mean, both of these are two separate versions. I'm sorry, I'm clubbing these two. But for China, what are the earnings catalysts you're watching in March? I mean, they've just started their next 5-year, process. And separately for India, how much of the recovery is dependent on oil prices coming down now? I mean, this looks like an added issue that India has to deal with. So from an equities perspective, thank you.
Yeah. So let me start maybe with India first, right? Because I think India is the one that's interesting, and you're right. There's no doubt that Indian markets, the equity market as well as the currency, are amongst the more oil price sensitive ones out there. And I think that is, I guess, a sensitivity we can't run away from. And I think that's where, for the period of time at least, and in a base scenario, this is just a few weeks, then we should expect to see that sort of pressure remain in place. But let's not forget that this is a market that has underperformed Asia ex-Japan by quite a significant amount, even before the current conflict and oil price sort of situation arose. And we just and related to that, arguably a bit of a consensus underweight, which we just think is not justified by what we see as not only improving policy, but arguably improving green shoots when it comes to corporate earnings growth, right? It's the phrase I believe I used was, we just need news to get less bad rather than turn unequivocally positive, right? So in the basket of opportunities, yes, oil prices, no doubt, we need oil prices pressure to go away for the market to perform. But it does raise the question, given the historical context, whether high oil prices are creating an opportunity. I think China is a little bit different, arguably a little bit less oil price sensitivity alone when it comes to the equity market. But for us, that's still about earning strength, and particularly from the policy priority sectors such as the technology sector. Now, our strategy in Chinese equities continues to be one which is a bit more of a barbell, right? So the high dividend paying SOEs on one level, but actually not the bulk of returns coming more recently from sectors like China Internet or the Hang Seng Technology Index. That and how the earnings sector pans out over there to us, in my mind, is still much more important. And yes, oil prices, I guess, and the downside scenario is more of a binary risk, but leaving aside that downside scenario, I think as long as the earnings growth continues to meet or exceed expectations, we still think that's an interesting market, particularly when you think about tech sector exposure and worried about excessive concentration in the US or US starting point valuations. China tech can actually offer another perspective on gaining exposure there.
Thank you, Manpreet. Just maybe one question. Oh, sorry, I'm going to take one question from the Q&A that's come through. And I think clearly, I mean, bonds and credit is a point of concern for a lot of us. What is going to be the impact on the Middle East real estate bonds? Are they still a good option, given that they have seen some significant price correction, or is it to be avoided now?
So without getting individual credits, which I think is important because there is a wide spectrum here, right? I think if you go back to a broader view on GCC credits, to our mind, this is a time to focus on quality, particularly if you're already getting opportunity from wider spreads and high quality. I guess this wouldn't be the the best time to focus on the riskier parts, the higher risk. Like in many environments, where of course that is a good opportunity, but at this point in time, we just feel like that sector and more broadly that group of credit ratings is not sort of a most preferred area at this point in time. We think in GCC, of course, the opportunities in high quality credits and of course credits that are linked to the sovereign in some degree. I think that to us would be a better place to start. Look, I do get the idea of saying, okay, where does opportunity potentially emerge? And of course, we're getting, I can see the case for seeing better value there. But I think the perspective I would take is, okay, if I want to take a riskier asset class exposure, is the regional real estate, fixed income sector the best way to do it? Or it's worth asking the question, should I be taking that type of risk to equities where my upside is less capped? Should I be taking that sort of exposure through a similar sector but in other regions, where my risk reward ratio might be similar or better? Because I think those are equally important questions to ask, because not to say that the argument may be wrong for the sector bonds in this region, but I think what's important is to also avoid falling into the trap of home bias just because that's what we follow day to day and miss what might be more attractive risk reward opportunities elsewhere.
Thank you very much, Manpreet. I appreciate you taking all of these questions, and I do understand there is one question. I know you don't take any particular instrument or single line question, so let me try and answer the question on. There is around one on bond funds like the PIMCO Income Fund and the Wellington Total Return. Again, so bond, as in funds, mutual funds, what happens with them is that there are a number of underlying securities, as opposed to you buying an individual security, and then the exposure to one individual security obviously is much higher to a fund where there are significant number of securities within. So it provides you that diversification, which is something that we normally recommend during such volatile periods. But just specifically on the PIMCO Income Fund, for example, it is an actively managed multi-sector bond fund, which obviously tries to maximize your current income, etc., from the markets. And because it's an actively managed portfolio, there is a fund manager that is looking at all of this ongoing developments and situation and taking some active calls on the underlying portfolio if need be. And typically PIMCO Income Fund is a fund that actually uses a fair number of hedges in terms of the overall positioning of the portfolio. So much like what Manpreet mentioned in terms of taking some exposure to US inflation bonds, inflation-linked bonds, tips are something that PIMCO also holds in their portfolio. Anywhere between 7 to 10% of the portfolio has been allocated to tips. And because it's multi-sector and high quality, you could expect that to be managed very well within the portfolio. Now, again, to Manpreet's point on bonds, I mean, there could be mark-to-market, movements from a price point. Clearly, they're all linked to the market, so any market movements will obviously apply to the instrument, but it's a matter of riding it out because you don't have exposure to one single instrument. I mean, there are like thousands of instruments within the portfolio, and so you're very, very well diversified. On the other hand, a fund like the Wellington Total Return Fund is an extremely conservatively managed fund. Again, an actively managed portfolio, but has a fair amount of U.S. Treasuries to hold on to the portfolio, and they're actively managing the duration risks within the portfolio. So they're typically looking at a 3 to 4 year kind of an exposure. Even though our call is 5 to 7, they're much lower than that. So they're a very, very conservative actively managed portfolio. So I think either of these two, if you have in your portfolios, you should just hold on to them. Again, look for positioning in terms of any leverages that you've added on these portfolios, and that in the overall scheme of your portfolio, if that's fine, then it should be all right. But worth having a conversation specifically on your portfolio with your RM and IA. But these two funds specifically are something that we would, get our clients to invest into today in a situation like this. So we should be all right with that. Coming back to you, Manpreet, I hope you had a short, quick break. But, I know we're running very, very quickly out of time, but I just wanted to leave one last question with you. Given all that we've discussed so far, geopolitics, oil prices, central bank policy, what is the one key message for investors that are possibly positioning their portfolios today, by which I mean that, if someone's bringing in fresh cash. Now, of course, there is a separate view on what one could do with an existing portfolio, which would require a case-to-case analysis. But if someone were to be adding fresh into into a or constructing a portfolio, what would your view be for them?
So I think it's a great point to end on, because I think, look, regardless of the environment, I think it's important still to get invested and stay invested. So yes, if there's that spare cash, I think that's absolutely something I'd be looking to get into a portfolio. But I think this is where the allocations to our foundation portfolio, the model allocation that we publish in our global market outlook, that to my mind is still the best place to start. Because at the end of the day, we've discussed a lot of topics on today's call, but investing, look, let's not forget, is about positioning for a wide range of scenarios. It's about taking exposure across a range of markets. So we're not concentrated on individual risks, such as the one we're experiencing now, or individual regions where you might carry disproportionate risk or reward. And I think that's what we try to achieve through that model portfolio. So I think for someone who's bringing cash to work today, number one message is yes, regardless of where you are in the news headline cycle or risk events, getting invested and staying invested is still better than cash. Because even in these environments, what we've learned time and time again, and there is a chart which we can share on this, right? Cash never seems to do better than just being invested, right? Even in times like this. And second is, yes, if you're looking to deploy that cash, then the best starting point when you speak with your advisor is to pull out the global market outlook and start with those model allocations, right? They're not a one-size-fits-all. Your own portfolios will obviously be a little bit different from those models, but those models incorporate all the hard work in terms of scenarios, risk reward, and what we think builds an optimal portfolio statistically. So we just think it makes sense to take advantage of that work and use that as your starting point.
Thank you, Manpreet. And the point you make on, sitting on cash is absolutely bang on. And especially in these times, given that, there is an inflation rising expectation, and they're never going to perform in line or better than what that, inflation could do to prices. But really, I think we've run out of time very quickly. Thank you very much, Manpreet, for your time. Incredibly clear and grounded perspectives, as always. This is a genuinely fast-moving situation. So I think it's great that we're taking time out and having these conversations. Just to bring it together for everyone, our base case remains that the conflict will be relatively short-lived. The market impact so far has been contained, and the strategy is to maintain core pro-risk positions while building targeted hedges, particularly in either defense equities, energy equity, US energy sector equities, TIPS, and of course, gold. So with that, thank you very much. I'll hand it back to Aisha. Thank you so much.
Thank you so much, Pratibha, and thanks, Manpreet. And ladies and gentlemen, we'll continue to watch the situation unfold, and we aim to meet you ever so often, face to face, or at least on webinars. And depending, we're going to return either next Tuesday or look at another date so we can come back and give you a fresh perspective on how we're seeing the situation unfold and how it talks to you and your individual portfolios, so that we can keep taking on questions, keep giving you feedback. But I think both Manpreet and Pratibha have highlighted what our core message remains. So please do stay close to that. And that is the same message that will echo across what your relationship managers are going to be speaking to you about, as well as your investment advisors. So stay close to us. Please feel free to reach out anytime to all of us here at Standard Chartered. We wish all of you a pleasant day ahead. Stay safe, and we'll see you soon. Thank you very much. Thank you, Manpreet. Thanks, Pratibha. See you all soon. Thank you.